Last week, I told you exactly where HIMS and HERS was headed, and if you were watching, you watched it happen in real time, almost to the exact dollar. What's up, everybody? Welcome back to Smart Stock Sam. If you're new here, I called the breakout on this stock before most of Wall Street even noticed, and today I'm giving you the next price target, because the setup forming right now is even bigger than the one that just played out. Right now, over 31% of HIMS and HERS shares are being actively shorted by Wall Street. That's tens of millions of shares betting against a company that just landed a massive war chest from one of the biggest banks on the planet. For the trading week of July 6th through July 10th, 2026, HIMS and HERS Health, ticker symbol HIMS, is trading right around $36.80. And it is staring down a massive $40 target. We've got rapid fundamental change, heavily trapped short sellers, and a gamma squeeze setup all colliding at the exact same time. Stick around, because before you even think about placing a trade, there's one hidden metric buried in this company's financials that changes everything about how it should actually be valued, and I'm not showing you that until later, so keep watching. Could this stock actually blow past $40 and keep running toward $50? The odds are stacked against it, but the mechanics we're about to break down might just make it possible anyway. Let's get into it. To understand exactly where this stock is heading this week, we need to rewind and look at what just happened over the last few trading days, because it lines up almost perfectly with the call we made. On June 29th, right here on this channel, I laid out a very specific forecast. I said the optimal entry zone was sitting between $33.85 and $34.10. I also said that if buyers could smash through the $34.50 resistance line, it would trigger a chain reaction across the entire options chain. Well, look at what actually happened. On June 30th, buyers shattered that $34.50 ceiling like it wasn't even there. And the very next day, total fireworks. On July 1st, the stock obliterated our $37 price target and surged all the way to an intraday high of $38.50. This wasn't luck. This was precise gamma squeeze mechanics playing out almost exactly as forecast. By July 2nd, the stock cooled off and closed at a healthy $36.80, carving out a rock-solid new support floor right at the $36 level. So if the last forecast played out this cleanly, here's a question worth sitting with. What happens when the exact same mechanics line up again, except this time with even more short sellers trapped underneath the surface? That's exactly what we're digging into next. Right now, this stock is being pulled in three completely different directions at once, and understanding all three is the only way to actually trade this intelligently. First, there's a rapid fundamental transformation happening behind the scenes, with massive strategic acquisitions and a totally reshaped product pipeline. Second, there's regulatory friction. The FDA and the SEC are both knocking on the door, and that's injecting real volatility into the share price. And third, you've got severely skewed market mechanics, meaning the options chain and a mountain of trapped short sellers are heavily distorting how this stock actually trades day to day. These three pillars are colliding head-on for our July 6th through 10th trade window, and once you see how they overlap, you'll understand exactly why institutional money is suddenly paying attention. Let's start with the fundamentals, because the first pillar alone should be turning heads on Wall Street. On July 1st, HIMS secured a massive $400 million master receivables purchase agreement with JP Morgan Chase. In plain English, a receivables facility means JP Morgan is essentially advancing HIMS cash today for money that HIMS' own customers already owe them down the line. Why does this matter so much? 2 words: zero dilution. Normally, when an aggressive growth company needs fresh capital, it issues new shares, and that dilutes your ownership and crushes the stock price. Not this time. HIMS just secured close to $500 million in immediate working capital to fuel its expansion, and it didn't have to issue a single new share to get it. Your slice of this pie just got noticeably more valuable overnight, and Wall Street is only just starting to price that in. And they're already putting that capital to work in a way most of Wall Street badly underestimated. HIMS isn't just a scrappy American telehealth app anymore. They recently closed a staggering $1.15 billion acquisition of Eucalyptus, instantly transforming them into a genuine global digital health ecosystem with operations now running in the United Kingdom, Germany, Canada, Australia, and Japan. But here's the part that could actually move the needle on domestic revenue the fastest. On July 1st, HIMS quietly launched its Medicare GLP-1 Bridge program. Weight loss medications are notoriously expensive out of pocket, and this new program drops the cost for eligible patients down to just a $50 monthly copay. By slashing that barrier to entry, HIMS just kicked open the door to a massive, previously untapped market. So here's a question worth asking. If this bridge program scales the way management is hinting it could, how much of that consensus price target is already outdated? But here's where it gets complicated, and this is that hidden metric I promised you at the top of the video. HIMS is currently going through what I call the pivot. They're aggressively moving away from generic, heavily scrutinized compounded weight loss drugs and shifting toward FDA-approved branded medications instead. They've inked major supply deals for Eli Lilly's Zepbound and Mounjaro, along with Novo Nordisk's Wegovy and Ozempic. In fact, one Novo Nordisk executive recently called HIMS one of their most voluminous telehealth partners, and that's a serious amount of prescription volume moving through this platform. But here's the catch. Branded drugs cost significantly more to procure than generic compounds, and because of this pivot, HIMS' gross margin took a real hit, sliding from a comfortable 73% down to 65%. In the finance world, an 800 basis point drop in margin is usually treated like a death sentence for a stock. So why isn't the market punishing HIMS for it? Because they're offsetting that margin contraction with an absolutely massive acceleration in sales volume. The real question is whether that trade-off keeps working in their favor or whether it eventually catches up with them. Now let's be completely objective here, because no forecast means anything if we don't weigh both sides of the argument. On the bull case, you've got $400 million in fresh JP Morgan liquidity, a $1.15 billion global expansion, a newly secured branded GLP-1 supply chain, and a massive upcoming FDA catalyst on July 23rd that could unlock a $10 to $19 billion total addressable market by 2030. That's an enormous runway. But now look at the other side of the ledger. HIMS is currently facing an active SEC probe tied to its past compounded semaglutide practices. On top of that, the FDA has been firing off warning letters over misleading telehealth marketing claims. Add in the gross margin contraction we just talked about, plus the fact that CFO Oluyemi Okape recently sold off $4,890,000 worth of stock, contributing to nearly $100 million in total insider selling over the past 12 months. That is a genuinely long list of red flags. And yet, right now, the market consensus is completely overpowering those regulatory overhangs, because investors seem to believe the pivot toward branded drugs meaningfully reduces the long-term legal risk. Is the market right to look past all of this so easily? That's the multi-billion-dollar question nobody has a clean answer to just yet. When you're not sure what to believe, the smartest move is always to follow what the heavy hitters are actually doing with their own money. And right now, Wall Street is furiously re-rating this stock. Canaccord Genuity just slapped a buy rating on HIMS with a street-high price target of $40. Barclays has them at overweight with a $39 target, and B of A Securities sits at $36. The blended 12-month consensus target has drifted up to $29.27, but the momentum is clearly pushing that number higher by the week. Zoom out to the float, and institutions currently own a massive 63.52% of this company. Over the past year alone, we've seen $1.75 billion in institutional inflows against just $1.48 billion in outflows. And remember that CFO stock sale I mentioned a moment ago? Well, Board member David Wells just stepped in and personally bought 48,400 shares on the open market for a cool $1.17 million of his own money. When a board member buys that aggressively right after a CFO sells, which signal do you honestly think carries more weight with the smart money? Fundamentally, the picture is complicated but leaning bullish. Technically, though, the charts are practically screaming. Every major time frame on the technical dashboard right now is flashing a strong buy signal. The stock is trading 20.4% above its 50-day simple moving average, which currently sits at $34.26. It's also trading 14.3% above its 200-day simple moving average, sitting at $29.71. The 14-day Relative Strength Index, or RSI, is sitting at a very healthy 58.55. That's the sweet spot. Strong bullish momentum, but still real room to run before this thing tips into overbought territory. On top of that, the MACD is sustaining a bullish crossover at a positive 0.76. Every chart is lining up in the same direction, but great charts alone don't cause explosive rallies. For that, you need trapped liquidity that has nowhere left to hide. And right now, the shorts are suffocating. Remember that 31% figure from the very top of this video. Short interest on HIMS is currently sitting somewhere between 31.09% and an estimated 42.83% of the entire float. We're talking about roughly 65.47 million shares that have been sold short against this stock. Based on current daily trading volume, it would take these short sellers 4.13 days just to fully cover their positions. These shorts are heavily underwater, and every single day they stay in this trade, they're bleeding cash in borrow fees. This creates the exact structural foundation needed for a violent short squeeze. Any meaningful upside push is going to force mass covering just to avoid margin calls. So what happens if buyers force their hand all at once? Let's find out, because the derivatives market has already built the exact trap needed to set this squeeze off. Look at the options wall for the upcoming July 10th expiration. The numbers here are staggering. On July 2nd alone, we saw a volume surge of 125,750 contracts traded, pushing total open interest across all expirations to nearly 1 million contracts. Now look closely at this chart, because there is a massive towering call wall sitting exactly at the $40 strike price, with 5,015 open contracts stacked right at that level. Meanwhile, there's heavy put support building underneath the current price at both the $30 and $35 levels. Market makers are heavily exposed here, and if price pushes anywhere near $40, it's going to act like an absolute magnet. Why does it act like a magnet? Because of a hidden market force I like to call the feedback loop. And once you understand it, you'll never look at a gamma squeeze the same way again. It starts with retail and institutional buyers pushing the stock past a key trigger level, in this case, our recent high of $38.50. The moment that happens, market makers who sold those 5,000 call contracts at the $40 strike start to panic. To protect themselves, they're forced into delta hedging, which means they have to rush into the open market and aggressively buy underlying shares of HIMS just to cover their own risk. That sudden wave of market maker buying drives the price even higher, and when the price surges, those short sellers sitting on 65 million shares start getting squeezed toward liquidation, triggering short seller panic. Now they have to buy shares too, just to survive. So now you've got retail buyers, market makers, and short sellers all buying at the exact same moment. That's pure rocket fuel, and it's aimed directly at the $40 liquidity zone. Could this actually send the stock past $45 before the week is even out? It's a genuine long shot, but this is exactly the kind of setup that occasionally makes long shots happen. Now, how you actually play, this depends entirely on your timeline, so let's break it down properly. If you're trading the short term, meaning the next 1 to 4 weeks, your entire focus needs to be on squeeze mechanics. Watch the gamma hedging thresholds, and watch the short borrow fee rates closely. The single trigger to watch is a breach of $38.50, because that's what forces market makers to start hedging against that $40 call wall. But if you're playing the long term, meaning the next 1 to 3 years, ignore the squeeze completely and focus purely on fundamental viability. Watch whether they can stabilize that gross margin around 65% and track their customer acquisition cost against their lifetime value per patient. For the long-term investor, the real trigger event isn't sitting in the options chain at all. It's the upcoming FDA ruling on compounding peptides, landing on July 23rd and 24th. But if you're here for the squeeze play this week, let's get into the exact numbers. Here's the actionable trade setup for the week of July 6th through July 10th, 2026. The bias here is definitively bullish, explicitly targeting a squeeze play. The optimal entry zone sits between $36 and $36.50. That dip we saw on July 2nd gave us a genuinely clean risk-to-reward ratio right at this level. Your strict support and stop-loss level sits at $36. That's our newly established floor, and if the stock breaks down below it, this technical setup is invalidated, and price will likely bleed back down toward that 50-day moving average around $34.26. The immediate resistance we need to break is $38.50, our intraday peak from July 1st, and it's the ignition point for the entire squeeze. If volume steps in and clears $38.50, our expected price target is that massive options wall sitting at $40. And if the shorts fully capitulate, our ultimate structural resistance sits at $41. So let's bring it all together. HIMS and HERS is sitting on a genuinely rare three-pillar launch pad right now. You've got booming fundamental GLP-1 sales backed by a $400 million JP Morgan facility. You've got a massive options call wall at $40, demanding delta hedging from market makers. And you've got over 31% of the float trapped short and actively bleeding cash. The regulatory overhangs from the SEC and the FDA are real, and they absolutely pose long-term risk. But for this specific trading window, the short-term market mechanics are heavily skewed toward an explosive test of that $40 barrier. Before you go, a quick and important reminder, because this matters more than any price target I just gave you. I am not a licensed financial advisor or a registered investment professional. Nothing in this video is personalized financial, investment, tax, or legal advice, and none of it should be treated as a direct recommendation to buy or sell any security. This is strictly my own personal analysis and opinion, shared purely for educational and informational purposes. Stock markets, options, and short squeezes are genuinely unpredictable, and past setups playing out the way this one did are never a guarantee of future results. Trading involves real risk, including the possible loss of your entire investment. Please always do your own independent research, verify these numbers yourself, and consult a qualified, licensed financial professional before risking a single dollar of your own money. Now here's my question for you down in the comments. If HIMS does break through that $40 wall this week, do you think it's the start of a real long-term breakout or just a short-lived squeeze that fades right back down toward 36? I genuinely want to see your case either way, so drop it below. If this breakdown helped you see the setup more clearly, do me a favor and hit that like button, and if you're not subscribed yet, go ahead and subscribe so you don't miss next week's forecast before the rest of the market catches on. If you want to go even deeper than what we cover in these videos, I've launched a membership right here on the channel, built specifically for traders and investors who are serious about leveling up their game. Inside, you get priority replies to your queries, earlier access to setups like this one, and a genuinely tighter community of people taking this seriously. So come join us if you're ready to take your investing to the next level. And if this video alone was worth a coffee to you, you can always send a super thanks using YouTube's built-in support feature right below this video. It genuinely helps keep this channel independent and these breakdowns coming every single week. I'm Smart Stock Sam. I will see you in the next update.